Welcome to Sectors Up Close. I'm Elena Casas. Today we're talking UK mid-caps in the FTSE 250 and my guest is Chris Beecham, Chief Market Analyst at IG. At last week's policy meeting, Bank of England Governor Andrew Bailey pushed back against the idea that the bank might cut rates anytime soon, saying its priority is still to reduce inflation. But the bank's own economic forecasts are pretty grim. Its best estimate is that Britain will show no growth at all in 2024, unemployment will rise to 5%, and a 5% fall in house prices this year will be repeated in next. UK households have already had to deal with the biggest fall in living standards since comparable records started in the 1950s. Well, investors clearly seem to have concluded the bank will be forced to cut rates sooner to try and pump some stimulus into a struggling economy. This is the FTSE 250 index of mostly domestically focused stocks. It's down 5% year to date, but it turned sharply up last week after the bank meeting on Wednesday. So, how optimistic should investors be? Let's ask Chris Beecham of IG. Chris, hi, thanks for joining us. Starting then with the Bank of England, we do seem to see a marked improvement in sentiment in UK stocks since last week's meeting. Do investors think a cut has to be the bank's next move, and do you think they're right?
I think it has to be. It's just a question of when, really. And the message from central banks, not just the Bank of England, but from everybody last week was, we think we're mostly done with hiking rates, but we don't intend to cut anytime soon. And I think the market is running the risk of falling into this trap that we've been through several times before this year, and indeed last year as well, of thinking, okay, the next cut is coming fairly soon. And I think sentiment clearly has improved this week, but overall people are probably getting ahead of themselves again on expecting when the next rate cut, when the first rate cut, should I say, will arrive.
Chris, despite the cost of living crisis and rising mortgage rates, consumer demand in the UK does seem relatively robust, which has been good news so far for consumer-facing companies. But do you think they're going to run out of road?
Well, that's the great surprise. We talk a lot about the strength of the US consumer, but actually European and UK consumers have held up much better than anybody expected. And I think the interesting thing about last week's comments and forecast from Bank of England was that they could have been a lot worse, really. I think they're still relatively optimistic given the way people are still fearing a recession. I do think that consumers have been burning down a lot of their savings over the past year, and the big problem I think is still going to be those mortgage rates. But the cliff in terms of mortgages and the cost of that is yet to fully hit the UK economy. So yes, I think consumer stocks, yes, well, they've done okay and well in the circumstances. I think there's still a much tougher environment, really. People's disposable income, I think, is going to continue to fall, even if we do get away with something that is with an energy cost hit that isn't quite as bad as we saw last year.
You mentioned valuations. Is it fair to say that from an international perspective, UK mid-caps are relatively speaking cheap, and does this make it a sensible time to buy them?
Yes, and we're not sure. I think it's to look at those two answers, really. Yes, by comparison, particularly, of course, with indices that have done really well, so the Nasdaq, obviously the Nikkei as well, valuations aren't really too pricey at this point in time. You can argue there is a margin of safety in there for the long-term investor, which brings us to the second part of the question: is it a good time to buy? As ever, it depends on a time frame. But if we're looking beyond the next 6 to 12 months, it probably is, really. I think we still see reasons to be optimistic on the global economy and indeed even on the UK economy more generally. It's just the question of if and when this recession arrives, which I know we've discussed many times before, and it's still the risk for the next, I think, 18 months for investors. So they could be in for up to 2 years of maybe less than stellar returns, but 11 times earnings for the index itself. It's really actually quite a competitive valuation, really.
Chris Beecham, Chief Markets Analyst at IG, thank you so much for joining us. Well, that's your roundup of the UK mid-caps. I'm Elena Casas, and this is Reuters.